Do you know what the biggest lie in modern banking is? It is the idea that your money is safe just because it is sitting in a traditional bank account. In this year of 2026, the world has changed. Yet most people are still using a savings strategy from 40 years ago. You have worked hard for decades to build your nest egg. You have sacrificed, saved, and planned for a quiet retirement. But right now, a quiet thief is entering your home every single night. That thief is not a person. It is the combination of inflation and the outdated interest rates offered by big banks. If you have your money sitting in a standard savings account at a major national bank, you are likely earning 0.01% interest. Let us look at what that actually means for your life. If you have $100,000 saved, that bank is paying you $10 in interest for the entire year. $10. That is barely enough to buy a sandwich in today's economy. Meanwhile, the cost of groceries, healthcare, and energy continues to climb. While you are earning $10, the bank is taking your $100,000 and lending it out for mortgages and credit cards at 7 or 8%. They are making thousands of dollars off your hard work while giving you pennies. It is time to stop being the victim of a system designed to keep you stagnant. You do not need to take massive risks with the stock market to protect your future. You do not need to buy speculative assets that keep you awake at night. What you need is a modern strategy that prioritizes safety, liquidity, and actual growth. I'm going to break down the 5 essential saving methods you must implement right now to secure your financial freedom. These methods are designed for people who value truth over hype. We are going to start with the foundation of any modern financial plan. The first method is the high-yield savings account. Many people in their 50s and 60s are hesitant to use online banks because they did not grow up with them. But in 2026, these institutions are more relevant than ever. A high-yield savings account is fundamentally the same as your regular savings account, but with one massive difference. Instead of 0.01%, these accounts are offering between 4.5 and 5% annual percentage yield. Think about that for a moment. Your $100,000 could be earning $5,000 a year instead of $10. That is an extra $400 every single month. That is your grocery bill, your utility payments, or money for your grandchildren's college fund. The most important question you should ask is whether it is safe. The answer is yes, as long as the bank is insured by the Federal Deposit Insurance Corporation. This is a government agency that protects your deposits up to $250,000 per person. If the bank fails, the government ensures you get your money back. It is the gold standard of safety. Online banks like Marcus by Goldman Sachs, Ally Bank, or Capital One 360 can offer these high rates because they do not have the overhead of thousands of physical branches. They pass those savings on to you. Moving your money to a high-yield savings account is the single fastest way to give yourself a raise without doing any extra work. Now let us move to the second method, which is the money market account. Think of a money market account as the sophisticated older brother of the savings account. It offers high interest rates, often slightly higher than standard savings accounts, but it adds a layer of convenience. Most money market accounts come with check-writing abilities and a debit card. This is perfect for your emergency fund or your life happens fund. If your water heater bursts or your car needs a major repair, you need that money immediately. You do not want to wait 2 days for a transfer from an online account. A money market account gives you that instant access while still earning you 4 or 5% interest. It is the perfect balance of growth and accessibility. In 2026, many money market accounts are yielding 5.2% for those with higher balances. If you have a significant amount of cash sitting idle, this is where it should live. But what if you want even more certainty? What if you want to lock in today's high rates before they potentially drop in the future? That brings us to our third method, which is the most powerful tool for a retiree's peace of mind. It is called the Certificate of Deposit Ladder, or a CD ladder. A certificate of deposit is a contract where you agree to leave your money with the bank for a set period, like 1 year or 5 years. In exchange, the bank guarantees you a fixed interest rate. The problem most people have is that they do not want to lock their money away for 5 years. What if you need it? The solution is the ladder. Imagine taking $50,000 and dividing it into 5 equal parts of $10,000 each. You put the first $10,000 in a 1-year CD, the second $10,000 in a 2-year CD, the third in a 3-year CD, and so on, up to 5 years. Every single year, one of your certificates will mature. You will have $10,000 plus interest landing in your lap every 12 months. If you need the money, you can spend it. If you do not need it, you simply roll it into a new 5-year CD at the top of the ladder. By doing this, you are always earning the highest possible long-term interest rates, but you always have cash becoming available every year. It creates a predictable, guaranteed stream of income that the stock market can never promise. As we look at the economic landscape of 2026, locking in a 5% rate for the next 5 years is a brilliant defensive move. It protects you from the volatility of the world and ensures your lifestyle remains unchanged. Now that we have built the structure for your big savings, we need to talk about how you manage your monthly spending. The fourth method is the sinking funds strategy. Most financial stress does not come from the bills we expect, like rent or electricity. It comes from the bills we forget about until they arrive. I am talking about the annual car insurance premium, the holiday shopping in December, or the quarterly property taxes. These expenses feel like emergencies, but they are not. They are predictable events that we simply failed to plan for. The sinking funds method involves creating small, specific sub-accounts for these goals. You might have one account labeled car maintenance, one labeled holiday gifts, and one labeled medical deductibles. Instead of hoping you have enough money when the bill comes, you save a small amount every month into these specific buckets. If you know you spend $1,200 on Christmas every year, you put $100 a month into that sinking fund. When December arrives, the money is already there. There is no credit card debt, no stress, and no guilt. It turns a looming crisis into a simple administrative task. Many modern banks, especially the online ones we discussed earlier, allow you to create these sub-accounts or buckets for free. It is like having a digital envelope system. It provides a level of organization that brings immense psychological relief. When you look at your bank balance and see that your property tax bucket is full, you can sleep soundly knowing your home is secure. Finally, we come to the fifth and most critical method. This is the one that makes everything else work. It is called the pay-yourself-first automation strategy. Human beings are not wired for long-term discipline. We are wired for immediate gratification. Even with the best intentions, we often find reasons to spend money today instead of saving it for tomorrow. Automation removes the human element from the equation. You must set up your finances so that your saving happens before you ever see the money. If you receive a social security check or a pension payment, set up an automatic transfer for the very next day. Have $50 go to your travel sinking fund. Have $200 go to your high-yield savings account. Have $100 go to your money market account. If the money is moved automatically, your brain will adjust to the remaining balance in your checking account. You will learn to live on what is left. This is how people build million-dollar portfolios on average salaries. They did not have more willpower than you. They simply had a better system. In 2026, technology makes this easier than it has ever been. You can set these rules once and let them run for the next decade. It is the ultimate set-it-and-forget-it strategy for financial security. Let us take a step back and look at the big picture. Why does any of this matter? It matters because your time is your most precious asset. You have spent 40 years trading your time for money. Now, in your later years, you should be trading that money to get your time back. Financial freedom is not about buying expensive cars or living in a mansion. It is about the ability to say no. It is the ability to say no to a stressful situation because you have a cushion. It is the ability to say yes to a spontaneous trip with your spouse because the money is already in the vacation bucket. It is the peace of mind that comes from knowing you will never be a burden to your children. The world in 2026 is uncertain. Governments change, markets fluctuate, and technology shifts at a blinding pace. But the principles of sound money management are timeless. You must be the warden of your own wealth. Do not wait for the big banks to offer you a better deal. They never will. Do not wait for the government to solve your inflation problems. They cannot. You must take the $100,000 or the $50,000 or even the $5,000 you have saved and put it to work. Open that high-yield savings account this week. Start that CD ladder with a small amount to see how it feels. Create your first sinking fund for your next car repair. Small actions taken consistently lead to massive results. Remember what we discussed at the beginning. The difference between 0.01% and 5% is life-changing over time. It is the difference between a retirement of scarcity and a retirement of abundance. You have earned the right to be comfortable. You have earned the right to be secure. But you must take the first step. The information is now in your hands. The tools are available and easier to use than ever before. The only thing standing between you and a more secure future is action. Thank you for spending this time with me. If you found this helpful, please share it with a friend who might be struggling with the same worries. We are all in this together. Take care of your money, and it will take care of you. I look forward to seeing you in our next deep dive into the truths of personal finance. Stay safe, stay informed, and stay independent.